Welcome to the deep dive. Today we're plunging into, well, a really foundational principle of the financial markets, something your sources, pretty much all of them, call the first rule of trading. And this deep dive, it isn't just about money, is it? It's more about a disciplined approach, a way of thinking when capital or really any big commitment is on the line.
Indeed. Yeah, it's funny. While traders, especially newer ones, often obsess over getting in a trade. The perfect entry, the hot stock. The real key to survival, the bedrock, as our sources really stress, is knowing your exit. Before you even start, it's a total shift, really, from just hoping for profit to managing risk seriously, preservation first.
Okay, right. Let's unpack this then. Wisdom from the market titans. Your sources talk about legends like Jesse Livermore, the boy plunger, right? Early 20th century. He learned the hard way, the painful price of hope, of hesitating. Trained himself apparently rigorously to cut losses instantly. Famously said, markets are never wrong, opinions often are. And he set that hard rule, didn't he? 10% initial loss cap, non-negotiable. Basically, if the market disagrees with your opinion, get out. Fast.
Absolutely. And then you fast forward, look at William O'Neill. His work, based on tons of data, like exhaustive studies of winning trades, he found this almost ironclad 7 to 8% stop loss rule. It's like a guardrail, just stops a small inevitable mistake turning into a portfolio killer. Then there's Paul Tudor Jones, often called the defensive grandmaster. He's all about capital preservation, above everything. His mantra, and this is great for you listening, is play great defense, not great offense. He always defines his uncle point, that absolute limit where he has to get out before he even puts money in.
Okay, this is where it gets really interesting for me. Because if this rule is so logical, if the best traders swear by it, why don't more people follow it? It seems our own brains, they're sort of wired against us here, like the sunk cost fallacy. That bias, right, makes us cling to losers trying desperately to get our money back instead of just taking a small hit.
And then there's loss aversion, that core idea from prospect theory. Basically shows the pain of a loss feels like twice as bad as the pleasure of an equal gain.
Yeah.
Roughly. So this psychological barrier, it leads to this really common destructive pattern, holding losers way too long, hoping they bounce back, and selling winners too quickly, just to lock in a small profit. So a predefined exit strategy, it's your circuit breaker. You're outsourcing that emotional decision, that critical choice, to your rational self, your pre-trade self.
Right. Okay. So given all that, the legends, the psychology, how does someone listening actually do this? Put this exit first idea into practice. What's the very first concrete step?
Okay. The first step is framing the trade itself. You have to identify its invalidation point. That's the specific price where your original reason, your thesis for the trade, is just proven wrong. That's where your stop loss goes. Simple as that. It's not random. It reflects why you got in.
And then the next piece, which I know you see as crucial, is position sizing. The linchpin, you called it. How does that fit?
Absolutely, the linchpin. Position sizing isn't about how many shares you want. It's about how many you can buy while sticking strictly to the 1-2% rule. Never risk more than 1%, maybe 2% of your total trading capital on any single trade. This connects everything. It links your exit point, that invalidation price, to your overall risk tolerance, mathematically. It guarantees that even when you're wrong, and you will be wrong, the loss is small, controlled, manageable. It's about survival, trading another day.
Now, okay, a simple hard stop loss like O'Neill's 7-8%, sometimes it can get triggered too early, right? Just by market noise, some random volatility. That makes traders hesitant to stick to them rigidly sometimes.
Yeah, that's a really good point. And it leads to a deeper aspect here. While, the exact execution might need some finesse, the real genius of defining your exit, its true power, often goes beyond just avoiding big losses. It's in what some call behavioral alpha. That's the extra edge you get, not from being smarter about markets, but from avoiding dumb mistakes, your own mistakes. These rules protect you from your worst instincts, panic selling, holding on forever. They let you stay in the game long enough for your good decisions to compound. It's really about managing you, because that's often the biggest source of error, honestly.
So bringing it all together then, mastering this first rule, it really changes things. It moves you from being just a hopeful speculator to someone who actually manages risk, a risk manager. It's about survival, longevity, not just quick profits.
Precisely. And it's an act of profound intellectual humility, really. By protecting your downside so rigorously, you give yourself the most valuable thing. Time to learn from mistakes, time to wait for the really good opportunities, and time for your sound process, if you have one, to actually work and yield results.
So for you listening today, maybe think about this. Where else in your life, maybe beyond just finance, Could you benefit from deciding your exit point before you really enter a new project, a big commitment, even a difficult conversation? Defining that invalidation point up front, it's a powerful tool, isn't it? For navigating almost anything with more discipline and less emotional costs. Something to think about.